Bitcoin and Fed rate cuts. Two things that don't seem to belong in the same sentence. But trust me, they're more intertwined than you might think. Let's dive into what this relationship means for anyone holding Bitcoin. Every time the Federal Reserve announces a rate cut, it sends shockwaves across the financial world. Borrowing gets cheaper, inflation fears rise, and investors start looking for assets that hold value. Enter Bitcoin, the digital gold. Why Bitcoin? Because when the Fed cuts rates, more dollars flood the market, potentially weakening the currency's value. Bitcoin, with its fixed supply of 21 million coins, becomes an appealing hedge. Limited scarcity versus unlimited printing. You do the math. Here's the kicker. During periods of lower rates, traditional savings accounts basically pay you nothing. It's like a bad joke at your expense, so people start looking for riskier or alternative investments, and Bitcoin is a prime candidate. Pain point alert. Lower rates and more liquidity often mean overinflated stock markets. People who feel priced out of stocks start noticing that Bitcoin doesn't have earnings seasons, CEOs, or balance sheets. It's just code and belief. Weirdly comforting. Pro tip, look at historical data. After the 2020 rate cuts during the pandemic, Bitcoin went on an absolute tear, skyrocketing to over $60,000. And while history isn't a crystal ball, repeating patterns aren't uncommon in finance. But it's not all rosy. Rate cuts often stem from economic troubles like recessions. Bitcoin is considered risky. Its price can go up, but it can crash too. Have a plan. Don't YOLO your savings into it because of hype. One of the sneaky ways rate cuts help Bitcoin is through corporate treasuries. Companies hate holding cash in low-yield environments. MicroStrategy, Tesla, and others bought Bitcoin because they saw it as a better alternative to holding dollars. A lot of people say Bitcoin is uncorrelated, but that's not 100% true. During sudden Fed rate cuts, Bitcoin and stocks often move together. But over the long term, Bitcoin's supply cap gives it a different type of appeal. Fed rate cuts can also impact mining. Cheaper borrowing means miners can finance better equipment at lower costs. Efficient miners survive, weak ones fold, and scarcity drives Bitcoin's price. It's a hidden domino effect most people don't notice. Here's the real deal. Bitcoin thrives on narratives. The store of value story gets a massive boost when rate cuts show the inherent flaws in fiat currency. The more people buy into that, the higher the demand for Bitcoin goes. To simplify, rate cuts weaken the dollar's purchasing power, create a fear of inflation, and make people rethink traditional investments. Bitcoin shines in these conditions because it's decentralized, deflationary, and immune to Fed tinkering. That's its magic. So should you sprint to Coinbase and max out a credit card on Bitcoin? Probably not. But if you're looking for an alternative to traditional assets, just know Fed rate cuts are one of Bitcoin's most subtle yet powerful tailwinds.